Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Well, we've had a crazy day in the market, and we'll start by looking at the trade from last week. Patience was a virtue with the trade last week in the S&P 500 index. A little bit fairly advanced trade. We looked at butterflies last week in the S&P 500 index. I think the title was Chasing Bears with Butterflies. Jay Powell's little speech at Jackson Hole had a little help in driving the market down, made that trade look very interesting by the end of the day. We're going to take a quick peek at that. But before we get too far along, let's look at what's going on in the markets. In the pre-market, we saw that the futures were up quite a bit. Actually, it looked like it was going to be a real strong day. We've had a reversal on that. Right now, we have the S&P 500 index down almost 1%, down $33.82. We can see this on the VIX watch list. And we also see that the volatility has spiked. So we're finally seeing some of the volatility inside the VIX index that I've been kind of expecting for quite some time. But we're seeing that volatility in lieu of the fact that the Jackson Hole event was last week. So volatility is spiking. Usually we'll see it spike a little bit going into a Fed meeting, but it's still staying strong. And we're at 2661. A little bit higher, definitely strongly above the 20% level in the VIX. And we're heading in, August is over. We got September and October coming. Volatility is always a concern. September has historically been one of the worst performing months in the marketplace, going back to over the last 50 years or so. So a lot of times, it's always independent events that can happen, but obviously, there's no rhyme or reason as to why September has underperformed the markets, but bottom line is that it has. So it's that simple. We're seeing high volatility in the VIX. We're seeing the S&P 500 index coming down. I was hoping we were going to have a strong move to the upside today, but that just didn't happen. A lot of energy stocks are getting beaten up. So today, we're actually going to go back to the energy well, and we're going to talk about Devon. That symbol is DVN. We saw some major news coming out, about last week, midweek sometime. Mr. Buffett did come in and say that he's still interested in Occidental Petroleum. We've talked a lot about Occidental Petroleum on this show. We've done more than one strategy, trying to bottom fish, trying to fear of missing out type trades that we looked at, how to manage risk in some of these energy companies, just in the marketplace in general. If you want to try to take some positions, but you're still nervous about the economy, and obviously the Fed is really, Mr. Powell came out and basically used the term painful quite often. I would like to say that was his irrationally exuberant moment in the marketplace, but his word was painful. And he used it quite often to just make sure that people know that the Fed is still hawkish, and they definitely are concerned about inflation, and we're nowhere near to that level. Good to see some of the commodities come off recently, even over the last month, but we still have a lot of concerns in food prices. We're seeing inflation rampant across a lot of the retail space. The consumer is strong. We got a big big jobs number that is coming out on Friday, and the Fed would like to see a bad news, good news relationship. They would like to see a bad number as far as jobs are concerned. I mean, I think Mr. Powell made that pretty clear that it's hard to manage some of the inflation with such a strong jobs growth that we've had. One of the lowest unemployment rates in history right now. One of the biggest headwinds, though, for the Fed is that we're going to have a lot of concerns about energy companies going into this heating season in Europe in particular. The Fed doesn't have a lot of control over exactly what's going to happen. We have geopolitical concerns that are still very apparent, and one black swan event could do a lot to make that energy market just basically tumble and see prices across the board on all energy stocks or all commodities in general skyrocket through the roof. So there's just one, the odds of something tossing the European environment into a recession and pulling us in with them are higher than they've probably ever been as we head into this earnings or into this heating season or winter months where Europe's going to have to deal with that energy crisis that they have going on. All right, so those are a lot of the concerns. It was nice to see the market up today, but the market is turning on a dime, and that is one of the signs of September and October. Just wild swings in the market, just flat out volatility, not necessarily performance, but just actual volatility of the marketplace during these months. Okay, so let's get on to the trade from last week. We looked at the S&P 500 index, and I'm going to get the chart up here fairly quickly. Okay, so what did we see in the S&P 500 index? If I look at a 1 month chart, I'm going to show you the one big red candle. Now, we always tape the stock play of the day live, and we do it on Tuesday. We don't choose when, but we're always using live markets. Chose to be a little bearish, and it was definitely a speculative, more advanced play. And I always got to emphasize this on all stock plays of the day. Nothing's meant to be a recommendation. We're just trying to learn. And a lot of the reasons why we did the trade and what we focus on here on stock play of the day are what are the pricing environment of the options and what strategies may apply to the current market pricing conditions in the options marketplace. And what we had was a rise up in implied volatility. And when implied volatilities are high, it's always good to sell some premium, to come up with some strategies where you're actually selling option contracts. And the butterfly, if you are correct on your forecast, wants implied volatility high when you put it on and would like to see it decline if you're correct on your forecast. So initially, when vols are high, butterflies will be cheaper. And vols didn't really come off, but we managed that by using shorter term options. And one of the things that's really nice about the S&P 500 index is that there's a plethora of expirations. It's a very confusing chain to look at, thanks to the Chicago Board Option Exchange. They've combined weeklies with monthlies, American style with European style, expirations every day of the week, almost. I think they might have them every single day of the week now. So very confusing chain, but it's a very liquid marketplace. Even with all those different choices in the options marketplace, it's still a very liquid, easy to execute trades in that index. Okay, so here's the big red candle. When we did the butterfly, we were hoping that the market would finish somewhere around 105. And if you see the trading throughout the day, the open was 41.33. The day went on. Mr. Powell was speaking. the market started to tank. The low on the day was, well, the open was 41.98. I got to keep my cursor right there. The low on the day was 40.57, which ended up being fairly close to the close, and the high was 42.03. So it didn't hang out much near the open for a very long period of time. So there were many opportunities, anywhere between 41.25 and 40.85. The market was hanging in that range. So there was many opportunities to just get out. This is when you would like the strategy or the underlying to be within the range, because you only have one day left. 1 hour's worth of time premium is something in the S&P 500 index, and that's because it is a 4,000 point index, and just the sheer price of the sheer value of the index that we're trading options on creates premium. But one of the neat things about options is that on option expiration Friday, all the time premium has to come out of the options. And if they're in the money, they're going to trade for the intrinsic value. And if they're out of the money, they're going to trade for zero. Basically no time value left whatsoever. So you know that that is going to happen on option expiration Friday. So many opportunities to get out of the trade. Just an interesting trade overall. If you were paper trading it and you followed it along, it was a cheap way to get bearish in the S&P 500 index, and that is a hard thing to do. Now, we did it on a 1x2x1 basis. Obviously, the leverage factor can always be a concern in options, but we always look at our strategies in the most simplest form. Okay, so that trade was interesting. Now we're going to go back to a little bit more straightforward trade. We've been looking at energy stocks and bottom fishing in quite a few of them. I mentioned Occidental Petroleum. We've done a few shows on Occidental Petroleum here on the stock play of the day. So now we're going to go back to the well, and we're going to look at Devon Energy. Devon is we're focusing a little bit more on natural gas, a little bit because of the concerns in Europe. Natural gas prices have skyrocketed recently. We're seeing a big down day, and we're going to take that as an opportunity. We're going to actually go out a little bit further in time, and that's what the stock play of the day is all about. A lot of times, if we're just speculating on a shorter term move or a move that we've seen in the charts, we're looking, we bounced off the moving average, we hit a Fibonacci, we think the market's going to go high, that type of thing. If you're looking at long call spreads, or call debit spreads is another term for it, bull call spread inside the options playbook is another term. If you're looking at those strategies, just like with a butterfly, you want the stock to do what you want it to do closer to the expiration date. You would rather have some time decay to happen. And that, like with a butterfly, our middle strike was 41.05, and we sold two of those 41.05s that expired on August 26th, which was the Friday on the close. That meant that in order for us to make the maximum on that trade, we needed as much time value to erode on the 41.05 strike put. And that's only going to happen really close to the expiration date. And we want it to just sit right at 41.05. So you have an at-the-money option contract that you want some time decay on. On a bull call spread, which I'm going to show here inside the options playbook, we'll be buying one option contract, and we're going to actually be pretty simple in the way that we're going to approach it. We're going to try to take the time factor as much out of the picture as possible by buying an in-the-money option contract and paying attention to how much time we're buying, and selling an out-of-the-money option contract that will be all time value. We're going to basically try to do something where we're going to be 50-50 in that. We're going to spend $5, which would be our maximum loss, with the potential to make $5. And by doing that, it means we're going to be straddling the stock price. So, for example, here on our long call spread, we're going to be buying strike A, and we're going to be selling strike B. We're going to be fairly close to right where pretend this is the stock as opposed to the profit and loss for the long call spread, the stock would actually be fairly close to where it's crossing the break even right here on our profit and loss graph for our option strategy. So if you envision that you just go dot, 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 and dot, 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 you're going to have unlimited upside if you own the stock and substantial downside all the way down to zero. We're just going to play between the strikes. We're going to say if the stock goes up, well, all right, we're going to give up some opportunity. We're going to sell some premium because markets are volatile. And we know that we're going to have a known upside if we're correct on our forecast. On the downside, though, if it goes below strike A, we're going to take our ball and go home. Our risk was defined, and we're going to be fine with that. You got to be fine with that risk if you're going to do a strategy like this. So to me, when I usually talk about long call spreads, and once again, it's all about the dynamics of pricing more so than trying to pick the perfect underlying here on the stock play of the day, right? We don't know your risk tolerance. We don't know anything about your history. But what I am saying is that we have a highly volatile environment, especially in the energy stocks. We have a big down move in the stocks today, so implied volatility has increased. And we're just kind of hoping that as we go into the winter months, September and October, we're going to go all the way out to the middle of October. We're going to use the actual third Friday of the month in October, and we're going to hope that we get that balance, that we get that move up in a stock that focuses on natural gas, Devon Energy. A little bit different than Occidental Petroleum. Pays a really big dividend, by the way, and a few of these companies do this where they actually have a lot of special dividends, and as their earnings grows, the dividend switches quite a bit, and you have a fairly high dividend yield, which does mess with the option prices. But we're not going to be too concerned about that, in that we are going to be buying call options. We're going to be buying one and selling one. We're going to focus on the amount of time premium we are buying versus the amount of time premium that we are selling. All right, so let me jump back and find my option chains for Devon Energy, and I'll show you the strategy that we're going to be looking at here. Okay, so Devon Energy right now is down 4.5%. The dividend, as you see here, we highlight it, and the dividend changes quite a bit, but right now it's showing $1.55 quarterly. It's actually increased quite a bit over the last 6 months or so, mainly because a lot of the energy stocks have done so well. So now the expiration, 17 days away, would be the September 16th expiration, and that's a common expiration that I would use on a long call spread. But I want to be a little bit more longer term bullish here on Devon Energy. And like I said, we're going to straddle the marketplace. So I'm going to pull up the normal expiration in October, 52 days away. And we're going to focus on the fact that we have some longer term implied volatilities here. So the underlying stock is at 70, 72. We have 5-point strikes. So that's going to affect our strategy. We might do something a little different if we had 1-point strikes. But personally, I like the fact that they're keeping them at 5-point strikes, mainly because that means you're going to have a little bit more liquidity in the strikes that are offered. When you saturate the marketplace with 1-point strikes, 65, 66, 67, 68, that obviously is going to spread the volume out amongst those strikes, and it has a tendency to widen bid-ask spreads. So I like the old school format of the fact that we're doing the October 21st expiration, and right now we're only seeing 5-point strikes. That was the old school way when I first started trading options. If the stock was over $25, they went up by $5 increments. Okay, so markets are okay. It's active. Obviously, the stock is down. We see implied volatilities up around the 50% level. So I wouldn't want to just be buying this option outright. If I'm doing that, I'm paying up some pumped up implied volatility, and I can literally just see that. If I want to get a quick and dirty way to look at the amount of time value that's in the call option, all I got to do is look at the put value. So we're paying about $3, let's call it $3.80 in time value. You can do the math, be a little bit more accurate, take the intrinsic value out and do all that. I just look at the put because I just want to do this quickly, and that's an easy way. The time value of the put will be close to the time value of the in-the-money call option, and vice versa, okay? And so we're going to straddle the market. The market is at 70.58, so we're going to be looking to go 5 points in the money and buy the 65 strike, and then we're going to go 5 points out of the money, and it's not quite 5 points, right? Because the market's at 70.60. It would have to, in a utopian world, the stock would be right at 70, and we're going to sell the 75. Okay. So in this in this marketplace, when we straddle where the underlying stock is at, you expect to have something close to a 50-50 situation, in that I'm betting $5 to try to make $10. And betting's the wrong term. I guess I'm investing. We're going all the way out to the October 21st expiration. So this is still a speculative play. The concern is that the market might move too quickly if I'm correct on my forecast, and I might not get rewarded quite as fast, because I'm still selling an option contract that has over $3 worth of time premium, and that needs to wither away in order for me to make the maximum on this trade. And we have 52 days worth of time premium on a stock that's trading at over a 50% implied volatility. So that is my little bit of my concern. But I want to be more longer term bullish on this underlying stock, and this is one way to do it. 1 second. All right. So here's our profit and loss graph. And to start with, if I highlight the profit and loss graph, we're going to see that the colored line is going to be fairly flat. This is as of today. And part of the reason why it's so flat is that we have so much time premium, because we went out 52 days until that expiration date. So because of that, to start with, if we go all the way up to 75, if we turned around and tomorrow was trading at 75, you'd be a little disappointed in your return relative to what you paid. On the downside, though, if you were completely wrong and the market went to 65, you'd be like, oh my gosh, I didn't lose as much as I was expecting either. Now, here's how that changes. I'm going to go all the way down to 1 day remaining to expiration just by clicking the days to expiration. And now you see that it's very similar to the dotted line, right? So as expiration approaches, you're going to, the actual profit and loss is going to morph into the profit and loss at that expiration date. So ideally, let's go 10 days remaining, you're still going to see that you're not as close to the maximum as you'd like to be if you were correct on your forecast, or as close to the maximum loss if you were incorrect on your forecast on the downside. All right, so we're coming to the end of the show. If you have any questions, as always here, we do the stock play of the day live so that we can get a little bit of interaction with a lot of the people that are attending. So please put them in the chat box. I'll continue to talk a little bit about the strategy. I haven't officially put it in the right rail, so it's not the official paper trade until I do. But please open up that chat box and ask any questions. It can be regarding the S&P 500 index trade that we looked at last week, or you can look a little bit more on this trade, even talk about Occidental Petroleum and some of the strategies that we did back then when we were looking at that underlying stock. All right, so let's make this official. I'm going to click the trade button here and put it in the right rail inside the Ally Invest option chains. And with Devon Energy down about 5% today, so we're looking about this type of move is really what we'd like, is to just get the bounce back of the $4, but we're going to give ourselves out until October 21st expiration. We're going to be buying to open one of the October 21st expiration option contract 65 strike call, selling to open one of the October 21st 75 strike call, doing this for a net debit. The midpoint right now is at $7.48. We'll call it $4.80 just for sake. Never a guarantee of the midpoint fill. Don't forget to add in commissions. This means that we have $480 at risk for every 1-by-1 spread that we do. On the upside, the maximum we can trade for is the width of the spread, which is 10 points, minus $4.80. That would be $5.20 on the upside. Less commissions would be our upside scenario. And our break even in this scenario, if we pay 480, would be 65 plus $4.80, or 69.80. So in this instance, the stock right now is at 70.49. So we are selling a little bit more time premium than we're buying. And because of that, our break even is actually a little bit below where the market's at. So hence when I said with the stock right in the middle, we're actually paying a debit for this spread, but we are positive time premium, which means our break even is lower than where the current market is trading right now. All right, so if we get the quick run up, you don't necessarily want to just hang around and hope that it stays up. Say it ran up to 75 tomorrow. I do want to consider just getting out. What would be okay with my profitability? The maximum I can make is 5. If I can make 4, I'm definitely want to get out. Maybe I'm out at 350 on it, because getting that last dollar with this many days remaining to expiration is going to be really tough. We need some time decay to happen. Or another thing that can happen is that the underlying could go way deep in the money, right? Now on the downside, if it came down to 65, if I was dead wrong and this downturn continues, well, anywhere below around 65 or below, I want to consider getting out. At the 65 level, I have an at-the-money option contract. There would be a lot of premium in it. If it happened right away, depending on maybe what I'm seeing in the chart or just in general, I might consider just getting out. I'm okay. I got to be okay with losing the maximum, which is $4.80, $480 for every 1-by-1 spread plus commissions on that trade. And if I need to be okay with that if I'm putting this on, because it is still a speculative trade. But I can say to myself, if this is trading for $2 or anywhere between $2 and $2.50, I might just get out. I'd be down a little bit more than half of my value on the trade. But my biggest thing is that if you do that, if that's your focus on the trade, is that you stay consistent on it. And we did pay $5 for this trade. Sometimes I look at spreads. I like to, on the stock play of the day, keep things around $300 when we're doing a speculative trade on a 1-by-1 spread type basis. But we're going a little bit longer term. So if I'm going to go longer term, I do want to have a little bit more upside. That usually means that you're going to have a little bit more downside. That's simple and straightforward. All right, so I'm going to run on over to the chat box and check it out. Let's see how, if you have any questions, please put them in the chat box. And if not, I guess we're right at time. That would be it. I'll give you a last call for questions. And going once, going twice. All right, well, that's it for this episode of the Stock Play of the Day. Come back this coming up Tuesday. We'll look at this trade and we'll review it, and we'll come up with another Stock Play of the Day. Thanks for coming, everyone. And please click subscribe and ring the bell. And we'll see you this coming up Tuesday on the next Stock Play of the Day.